Okay, good afternoon and welcome back everyone to another special edition of Trading the Markets with Tom Sosnoff from Tastyworks. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay, and today we have a very special session talking about how to trade in a volatile market, which is exactly where we find ourselves during today's market. So first of all, before we jump into it, Tom, thank you so much for being here. Welcome. And I hope everyone in the chat window, please type your name, where you're joining from. I'd love to see all of you here in today's session.
Thanks, Tony. Happy to be here.
So Tom, today we're going to be talking a little bit about volatility. This is going to be quite fun given the current market conditions that we are in. However, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we might use as educational or example purposes during today's session. And there are so many of you that have joined us here today from pretty much all over the world from what I can see. So first of all, welcome. Some of you from Europe, some of you from South America, Australia I've even seen. So first of all, thank you so much for joining Tom and I here this afternoon here in New York. Now, a bit of housekeeping before we get started. Both the OptionsPlay and the Tastyworks team is working both the chat and the Q&A window. So as Tom and I go along and talking about the markets, option strategies, the platforms, if you have any questions, feel free to type them into the Q&A window. We will try to, and our team will try to answer as many of those things live, and Tom and I will try to take some questions here at the very end. But many of you have submitted questions ahead of time, and we'll try to answer as many of those during today's session. So we'll start off by just taking a look at the broader markets. We'll talk a little bit about some of the option strategies, but I think we're going to keep this as interactive as possible and really try to ask Tom as many questions regarding the current market and how he's viewing these specific strategies. So before we jump right into it, Tom, I'll give you just a couple of seconds to talk a little bit about your background for the few of you that do not know who Tom is. The thing that I always go back to is I learned how to trade options watching your webinars. This was about 16, 17 years ago when you were doing almost daily webinars on Thinkorswim. And that's how I learned how to trade futures. That's how I learned how to trade options. And here I am today. So Tom, thank you for what you did for your entire career. And thank you for what you do now.
Oh, hey, I'll take it. I need a little help after a day like today. So yeah, I mean, I love doing these webinars with you, Tony. And like you said, I've been doing them for forever with, both with our different marketing partners like you and also with, on our own. And I still try to do as many live events as I can. This weekend, I was doing a showdown for a bunch of students in Mexico and actually down in Guadalajara. So, I mean, I'm a junkie, man. I love this stuff and I trade a lot still. So think today made 150 trades almost. So I'm pretty much I'm about as bad as you can get when it comes to loving this business. So I think it's a great day that you picked a topic on volatility. I mean, I can't remember a day when the market was down almost, when the S&Ps were down 4.5 or more on a percentage basis. I can't remember a day the NASDAQ was down over 5%, and we did have a really nice explosion in volatility today. I mean, I'm not saying nice in the sense that, it was good for money making, but it is going to open up an incredible amount of opportunity for the next couple of days or weeks. So I think it's a great day to have this discussion. So let's do it.
Yeah, thank you so much. And I'm glad that you brought up the term opportunity, because that's really how I'm viewing the current market conditions. Not everyone necessarily feels that way after a day like this, where you could have taken quite a bit of pain depending on what your positions look like going into today. So Tom, I want to start off by talking a little bit on a broader scale before we dive into any type of strategies or anything like that. I think you stand out in the trading community, if you will, from the perspective of you're one of the few people that we talk to and have as guests here where you don't really look at technical analysis. You're not a big fan of using the charts or indicators to determine kind of entries and exits. One, you kind of feel the markets a lot and you tend to be more of a vol trader, but you also stand out from the perspective of you're much more of a contrarian, right? You tend to be a buyer when everyone's a seller. You tend to be a seller when everyone's a buyer. So I do want to ask you, markets are down little over 8% over the past, let's say 3 weeks or so, which is statistically speaking a little lower than a little bit faster to the downside than we normally would see in a normal market. How are you viewing this? Let's first talk direction first before we talk vol. How are you viewing this market that we're currently in? As we're down 4 or 5% on an intraday basis, are you the type of trader that's looking at this as a buying opportunity? Do you think that, structurally you're looking at the bigger picture and you're saying things are looking more bearish? I'm looking for more bearish opportunities. Could you share a little bit with us,
Yeah, sure.
as a broader directional view?
So just to give a little background, I'm not a technician at all. I don't actually believe in technical analysis. I don't do any fundamental analysis. I don't care about the larger macro picture. When I say I don't care about it, it's not like I don't read or do anything like that. It's not interesting to me as an opportunist. I think that as a strategist, as a market strategist, which I believe I am, because I'm indifferent to product, I feel like my objective and my obligation to this space is to take advantage of whatever's out there opportunistically, which means you kind of run towards the noise and you figure out how to take advantage of it, which is not something that's easy and not something that you can then not something that's predictable. I don't believe that anybody knows what's going to happen, tomorrow, the next day, or next week. I think that's a ridiculous. If you work off that premise, you will never make money in the markets. So I believe that money is made through a very mechanical approach to strategy, and it's made from being consistent, and it's made from longevity. Tony, one of the things that you do that's great, and one of the things that I think I've done, because I've survived for over 4 decades in this business, is we believe in a small amount of like everything you do is strategic. And we both believe in a small amount of mechanical, or what we call strategic edge, or optimal mechanics, of which allows us to create a lot of longevity. It gives us duration to what we love to do. And over time, that duration means that you take advantage of opportunities, because there's the beauty of, I think, what I do, and I think what you do, which is very similar, is there's no negative. Like, we don't have negative odds to the house like a casino or something like that. There's nothing negative about what we do with respect to house odds, which means we're on a very level playing field. We have the same chance of making money as we do of losing money. So if you believe that theoretical pricing is very fair and it's a level playing field, then ultimately what we want to do is we want to stay around as long as we can. And when there's opportunity, take advantage of it, because that's how we succeed. We do really well when there's opportunity, and we survive when there's not opportunity. And I think that the key to that is accepting that, hey, markets are random, markets are efficient, but markets also provide an incredible amount of opportunity. So that's the way I treat this business now. And I think it is, rather than trying to guess what the S&Ps are going to do tomorrow, I'm going to try to see, where the most opportunity is in the S&Ps tomorrow. And that's a very different approach than we might have had, 10, 15, or 20 years ago. But the technology is better today, the markets are better, and the pricing is more efficient. So you can do that.
Yeah, and you and I can probably talk about just that one thing that you spoke about all day long, about the opportunity, and
Sure.
you talked about survivability, or surviving to even be able to take on that opportunity. And that's really something that we spend a lot of time here at OptionsPlay talking about, which is trading small, so that no single trade, no even series of trades, no bad week or bad month blows up your account, so that you can survive to find those opportunities, potentially trade those opportunities, because a lot of traders tend to have blown themselves up to not survive that ability to take on that opportunity. And I think that's so important when you talk about longevity as a trader. So that really helps, I think, hopefully everyone who's watching this today, a view into kind of how you're looking at the broader markets. So let's talk a little bit about vol. VIX today, where did we end up closing on the VIX? I didn't get a chance to see the close. We were at 27, on the 27 handle on the close. So, this wasn't an extreme move on the VIX relative to that 4 or 5% move we saw in the S&P and the NASDAQ. How are you viewing this from a volatility stance from today?
Um, Volatility has been really interesting this entire year. In past years, when we've had the kind of when we've had a bear market, we've had an extreme amount of outlier volatility. And I'm glad you asked this question, because we just, Tasty Trade is a think tank, and we just did a ton of research on this. And you'd be surprised to know that over the last 20 years, just about, actually closer to 30 years, since 1990 from 1990 to 2021. So basically 31 years. The average volatility has been, I want to say, just about 19.8. And this year we're averaging like something like 20, just a little bit over 20. That's average. And then the mean is a little bit higher in both cases, about 2 points higher. The point is that there's almost no deviation in 2022 than there has been for the last 30 years with respect to vol move. So whereas this year you think vol's really rich because it is higher than it's been, it's actually hasn't deviated that much from the last 30 years. Now, where do I think vol is right now? I think the most interesting thing about this year is that there's no outlier risk priced in. So if you look at skew right now, it's trading in the low 120s, which is amazing. Consider there's no fat tail risk in the market, and there hasn't been all year, which means that all the volatility is concentrated, which is why you saw only a 4%. I mean, we're saying only a 4-point move in the VIX today, or only a 10%, 15% move in the VIX futures, is because there's no fat tail risk right now, Tony. It's all front month, like kind of at the money volatility. And usually that means it'll be short-lived. It's just a nervous market without fat tail risk. It's very weird, but I also think that's good for trading, because you're not worrying about the crazy, crashes and things like that.
Yeah, this bear, if you want to call it a bear market that we've basically seen since January, has felt quite orderly.
Yeah.
The moves to the downside, the rallies subsequently, everything has just felt quite orderly. Nothing these huge monster days where you feel that you're just not sure where what to do with the markets. So it's hard to put your finger on it, but certainly feels just less jumpy as the markets have been over the past few years, as some of those crashes that we've seen. So thank you so much for sharing that. So I think that the best way for us to really have an active discussion around, how are you adapting, if you will, to a more volatile or perhaps even a bear market, is to go through some of the questions that our users have submitted. And we're going to kind of try to have a discussion. If you have the ability, or if you feel that it's best to show your platform to answer some of these questions, feel free to do so. I tried to put these questions in somewhat of an order that kind of progresses us from more bigger picture to more detailed understanding of some of these strategies. And some of these questions I've paraphrased a little bit to help try to answer questions that I think the broader audience would benefit from. But let's start off by talking a little bit about what type of option strategies do you use for bear markets? And I think specifically a bit of clarification on this is, when you have a bearish view of the broader markets, or perhaps an individual stock, what type of option strategies do you typically lean into for trading those types of opportunities?
Okay, so if I'm trading an individual stock and I'm bearish on an individual stock, I have a very aggressive approach. So I usually will either sell call spreads or sell naked calls. I rarely buy puts, and I rarely buy put spreads, because usually when I'm bearish, I want to be short some out of the money premium. And, I want to also give myself a little room to be wrong. So that's my kind of aggressive approach. I also, when I'm bearish on the market, the overall market, I tend to use the S&P futures, the NASDAQ futures for static delta, and for non-static delta or dynamic delta, I use the ETFs, the underlying ETFs. So Qs, spiders, most IWM, those three pretty much. I don't really use a lot of the sector ETFs, and I tend to use skewed strangles. So I will sell, for example, a 30 delta call and a 15 delta put. I just want short deltas, but I'm not willing to concede that I know anything. So I sell the put because it requires no additional capital and it reduces my risk. So broad market, static delta, I use futures, and a dynamic delta, I use skewed strangles, with the put being half of the call delta. And then for individual equities, I use short calls and or short call spreads. I will use a bunch of ratio spreads, but I don't think they gave me the same delta. So when I'm bearish on the market, I'll use call ratio spreads. And when I'm bullish, I'll use put ratio spreads. Now that's very different for me, Tony. When I'm bullish on the market, when I'm bullish on a market or the stocks, I really like a short put strategy, especially when I'm bullish on individual equities. And I will use the exact opposite approach of being short a strangle with a much skewed strangle with a much bigger put than call if I'm bullish.
So a lot there to unpack. Okay, let's just break that down into a few things. Let's first differentiate static versus dynamic deltas. Static delta is referring to a position that gives you effectively the same dollar for dollar approach to the downside. That's why you're shorting futures. So if the future goes, if the index moves down by 100, let's say $10, you get the same profit as if it moves another $10 to the downside. So the delta stays consistent. It's 1-for-1 to the downside. Dynamic delta is referring to a delta that changes. That's we're referring to using options. The convexity that you get from delta that changes, where gamma is either increasing or decreasing delta as it goes in your favor or against you. And you specifically talked about selling a skewed strangle. And let's just break that down again. So the strategy driver, you mentioned you're selling a 30 delta call and selling a 15 delta put, which in most investors' mind, when you think about selling a strangle, that tends to be a more neutral view, but you are skewing the strikes so that you're getting a little bit more downside. You're getting a bit more downside. So even if the stock or the underlying security moves down, you have a fair amount of moves to the downside. And the reason that you're still selling that 15 delta put, even though the strategy driver of that strategy is actually the short 30 delta call, that's the primary reason or that's the primary leg of the strategy. But you're saying you're also adding a 15 delta put to it because you're going to collect a little bit more premium, gives you a little bit more buffer, if you will, so that if the equity does move substantially higher, substantially lower, you have a little bit more premium to offset those losses. And at the same time, you are short theta in addition to being short delta. And I think that's really the thing to take away from this, is that no matter how bearish you are in the broader markets, you're almost always short vol and short theta.
Yes, but I want to just qualify that for 1 second. So your question was, what option strategies do you use in bear markets? That I didn't answer that question. I answered the question of what strategies I use when I don't like something. Most of the time, because you started off explaining my trading philosophy pretty well up front, I'm a contrarian. So most of the time I play things to the downside, it's in bull markets. In bear markets, and I do agree, we are in a bear market this year. This absolutely qualifies as a bear market, what we've seen so far this year. In bear markets, I do not tend to be short because I don't necessarily believe that, I don't think anybody actually knows that we're in a bear market. Like I could sit here and say we're in a bear market, but I'm looking for spots to buy things, not sell things. In a bull market, I'm looking for spots to sell things, not buy things. In a bear market, I'm looking for spots to buy things. Like I'm looking at the market here today and saying, well, we're at 39.50. I'm actually interested in getting a little long delta at 3,900 tomorrow if they drop another 50 handles. So I didn't buy anything today, but I'm like this market, maybe 50 handles lower. So in bear markets, I'm actually looking to get long. In bull markets, I'm looking to get short. So my philosophy is very different than most people, but I wanted to explain what strategies I use to get short something.
And thank you for that clarification. A true contrarian in the truest
Well, I didn't want to scare the children who are listening. That's right.
Well, thank you so much for that clarification. And hopefully I explain what the difference between dynamic versus static delta and what Tom meant with respect to shorting a strangle.
Your explanation was great.
Which I think sometimes could be misconstrued as more of a neutral strategy. So let's move on. Let's talk a little bit about protecting your portfolio during a down market. So let's not, and this doesn't necessarily have to apply to where we currently sit in the broader markets. Perhaps back in January, you were concerned about the froth in the market. You were concerned about the valuations that we're seeing, and you were concerned that there could be a market drop. How do you think about protecting a portfolio against these types of down markets?
Okay, so this is a personal this is a very personal pet peeve of mine, but I do not believe in hedging. I believe in basis reduction. There's a big difference. Let me explain. And I've been doing this. First of all, the second part of the question I'm going to explain real easy. How do you protect your portfolio against inflation? You do not. I have no idea why you would want to protect your portfolio against inflation. All inflation means is if risk-free rates go higher, then your opportunity to make money using market strategies should go up on a percentage basis, multiples of that. So higher inflation means more opportunity in the markets. You're not protecting against so-called inflation. There's nothing you can do in that regard. What you're doing is you're just using what the market's giving you as with greater opportunity. There's no way to protect against inflation, and you shouldn't even want to. But with respect to portfolio hedging in a bear market, you can get out, but the reason you can't hedge is because the cost of buying protection against fear always outweighs the payout. There's no mathematical model where hedging is actually occasionally you catch lightning in a bottle and you can hedge something and maybe it works. But the majority of time, you're paying a much greater volatility number than the underlying is. Just think of this. Why would somebody sell you protection at fair value? They sell you protection at some inflated price that makes absolutely no sense to buy it. And so I don't believe in protection. What I do believe is in reducing risk. So for example, if you are long a stock and you wanted to sell a call against it because the stock was going down and the volatility was going up, those calls were theoretically more expensive than they were before because option premium is higher, I'm totally fine with that. I'm not fine with buying a put against your long stock because that just costs too much money and it has a very low probability of success. I am fine with selling a call against your long stock because that lowers your basis and that reduces your delta risk. That makes sense to me.
So two additional questions to that. One, what about selling calls and then buying puts with it, or what we would traditionally call as close to a zero color? That's a common question that we get. And two, what about shorting futures against a stock, a portfolio rather, to reduce risk?
Okay, great questions. So shorting futures against a portfolio, the problem with that is that futures have no premium. So if you're selling options, like let's say you want to sell against a portfolio, let's say you want to sell SPY options and you use every SPY out of the money call as the equivalent of, let's call it $40,000 worth of notional. So let's say you had a $200,000 portfolio of stocks and you sold 5 calls against that in the SPY. Well, at least you're collecting premium, you're collecting theta, so I have no problem with that. The problem with selling one S&P future, which is, let's call it, is the equivalent of $200,000 exactly. The problem with that is it does hedge your position in a theoretical sense, but how do you know what you're supposed to do? Like, let me ask you, what's the next? Let's say you sold S&P futures yesterday against a $200,000 portfolio. You sold one future and today they're down 175. Now what do? Do you take your hedge off? So it worked as a one day, it worked for one day, or do you what's the game plan? What's the unwind? I don't think on paper it looks like, oh man, I hedged my position. But the reality is you'd have been better off just closing out the position, or you're never going to know when to take that position off. So I don't like trying to protect a portfolio by selling futures. I love trading futures. Don't get me wrong. I like futures options. I don't like hedging a portfolio using futures. Now, if you're nervous about your delta and you just want to reduce some delta by using a static product like futures, sure, go ahead. But just think of it as a trade. Don't think of it as a long-term hedge.
Good advice. I like that. Let's talk a little bit about collars. I don't know if you ever trade collars. Maybe you guys have done quite a bit of research on collars, and perhaps we could think about it from as two separate strategies. And maybe we should think about it as two separate strategies. You know, when you're thinking about the expiration date and strike price of a collar to protect an equity position, you talked about selling call options to reduce risk. So let's talk about just the cover call side. How do you think about selecting expiration dates and strike prices for a cover call in this example where you were saying, I want to reduce basis, I want to reduce delta, what expiration and strike price are you going to?
Okay, so this is real simple, because one of the keys to, I'm going to get back to the original thing that I said, which is one of the keys to long-term success as a trader or investor or an active investor is you have to be around. You have to have this longevity to be successful as an investor. It's all about longevity. And so you need mechanics. Don't guess, don't start thinking each underlying is different. You have to be indifferent to product. So if you're thinking expiration dates and you're thinking strike prices and you're thinking, what is optimal, you should be able to look at soybeans, bonds, Apple, Netflix, IBM, any stock, any underlying, any product, Bitcoin, Ethereum, whatever you want to trade. It doesn't matter what it is. Everything should be mechanically the same. So you should look, all you need to do before you even, you just pick an underlying. You don't even have to go to an option page and you say, hey, I'm going out closest to 45 days, could be 55 days, could be 35 days, but closest to 45 days. And I'm going to somewhere around the 30 delta. It could be 35, it could be 25, but you're going somewhere around the 30 delta option, which will reduce your risk by about 30%. Theoretically, and you're going out the perfect part of the decay curve, which is around 45 days. So 45 days, 30 deltas, that's my default. No matter what, we just find the closest one, and it doesn't matter what the underlying is. It doesn't matter what the product is.
So I think this is actually worth having a slightly further clarification on this. I will tell you that our, and we do quite a bit of research on these types of strategies, just like you do.
Sure.
We tend to favor closer to the 10 to 15 deltas when we're doing cover calls.
Listen, as long as you're consistent, I don't care. It doesn't like that's my number. Like if you're doing 10 to 15 because you like your underlying, perfect. Just always do 10 to 15. It's consistency.
Right. I just want to clarify kind of the difference between the two, right? Like where we teach that the 10 to 15 deltas for the most part because of the capital appreciation component of the equity. We, based on our backtest, if you want to have a fair amount of capital appreciation, that 10 to 15 delta is that sweet spot where you're not giving up capital appreciation in exchange for a higher income level in the short run. But I do want to ask one question to you, and this is a question that I don't think is coming from me, but probably coming more so from the general audience, because we know that 50% of trading volume in single legs is under 30 days. Actually, if I'm not mistaken, 50% of the trading volume is now closer to the 2 to 3 week cycle. So tell me a little bit about why 45 days is what you're searching for on a cover call, when theoretically speaking, if I sold a 2-week call and did that 3 times, in theory, I would collect more premium than selling one 45-day call. So could we talk a little bit about kind of your thought process behind that 45 days?
It's actually not about, it isn't about a thought process. So what's so interesting is that it's literally not about a thought process. It's just about optimal mechanics. So there's a decay curve. And when you look at out of the money options, specifically the options that you guys like, which is 10 or 15, but 30 can be the same thing. When you think about out of the money options, the decay curve and out of the money options, okay, and all out of the money options, it is the strongest part of the decay curve is from 45 days to 21 days. When you get into the last 2 weeks of that decay curve on out of the money options, they don't decay. So they actually go the other way. So when you look at a decay curve, there is, I don't know if you can see my hands, but a normal decay curve will go like this, right? And that's for an at the money option. So it's a little bit, it's a little bit rounded, but it goes like that. When you sell out of the money options in the last 2 weeks, the decay curve, it goes like this, and it goes back up, because when out of the money options get cheap in the last 2 weeks, they don't go down anymore, or the amount that they go down by is very small, because nobody wants to sell junky options. So you get this decay curve where the steepest part is in that 45 to 21 days. And at the very end, it turns back up. And that's why we used a little bit bigger option and we go to that 45 days. And most people think that, that because you get the greatest acceleration of decay in the last 2 weeks of an at the money option, that it works that way for out of the money options, but it doesn't. Out of the money options turn back up in the last 2 weeks. At the money options continue to decay at a faster rate in last weeks, but you have a lot more gamma risk. So to take the outlier risk out of the trade, you want to be at that 45, 50, 40, 35 days to start. And then you take it down to 21 days. By doing that, you eliminate your fat tail risk about 99.5% of the time. And then you don't also have to deal with that turn back up on those out of the money options at the end of the curve. It's a really fascinating study. When you guys, if you start breaking that down, Tony, you'll see that the 15 delta, the 10 delta, the 15 deltas, totally fine. Gives you more upside on the stock, but you also end up taking a lot more risk and make a lot less money as you get towards expiration. That's the tough part about it.
Yeah, so we actually typically roll these at least about 2 weeks out as well, 2 to 3 weeks out.
Sure, well, that's perfect
on these cover calls.
That's perfect.
Yeah, because those, as you said, those out of the money call options in those last 2 weeks, especially out of the money, they kind of just sit there, and you're not able to buy them back at necessarily what their theoretical value is.
They're not worth the risk. You're exactly right.
Right. So thank you for that clarification, because that is a common question that we get almost consistently when we talk about why we sell 45 days out instead of shorter dated options that in theory provide more premium if you do it more often. So this kind of talks, this is something that we have touched up a little bit on, but what adjustments do you make to your overall portfolio or strategy as volatility picks up?
A ton. And there's no adjustments that you can make to, when you're short volatility, there's no adjustments you can make that will reduce the exposure to your short vol. It's like when you have a positive theta number and your short premium, like you have a positive extrinsic number, there's nothing you can do to your position that's going to defend it intraday on rallies and volatility like today. But what I do is I do the one thing I can do, which is adjust my deltas so that I don't let them get out of hand. Because it's one thing, there's certain things you can control, right? You can control your size at order entry. You can control this type of positions you put on. You can control your strategies. You can control your diversification. What you can't control is what the market does. You can't control price and you can't control volatility. So you can take advantage of it, but you can't control it. So because I can't control volatility, I can still adjust price. And by doing that, I will roll, obviously, if we're going down like today, I'll roll calls down all day. And if we're going up, I'll roll puts up. And so effectively, I'm defending my delta. And I'm hoping that over time, since volatility contracts more than it expands, that's how I make my money.
So just to clarify, what you're saying is that when a move like today, where the market's down 4 or 5%, and you're rolling your calls down, you're doing that so that you can bring your delta closer to neutral or closer to your target delta. And then so that you can remain short vol and short theta.
Exactly.
Great, thank you so much. And this is sort of, I guess we sort of just answered this question here, but the question was, you're mostly selling strangles. Do you stay away from selling strangles as markets become more volatile?
No. Actually, no, this is here's a great, whoever asked this question, I'm going to give you a really strong response to this, because there is significantly less risk when you sell premium into high volatility than low volatility. This is a crazy thing. It's not what everybody thinks but they're significant. It's almost a 2 to 1. It's over a 2 to 1, like 2 to 1, 2.5 to 1 advantage, meaning that you have less risk of continued volatility expansion and you have a lot more potential for contraction. The biggest risk for selling premiums like Strangles is in low volatility, because you can have an asymmetrical move to the upside in volatility. When you have high volatility like we have right now, you have the lowest risk in selling premium. Sure, vol can go from 27 or 28 to 40, but it's only done that 5 times in 35 years. So it realistically, when you look at the numbers, selling premium in high volatility when markets are volatile is much better than low volatility.
And so two things to add to that, right? Because this backs up not only from a vol trading perspective, which I do want to have one clarifying question to add to that, but it also actually aligns with some of the statistical and technical studies that we do on this front as well. You know, as to technically speaking, from a statistical perspective, when is the best time to sell strangles or straddles? And it's actually after an equity makes a huge move when you tend to have that settling of volatility, right? And which is sort of saying the same thing, but you know, because volatility and direction are many times inversely correlated, we're saying that after that big move to the downside, that is usually when most people are most scared to sell straddles and strangles, but actually opportunity-wise is actually the best time. And we're saying the same thing, one from a vol perspective and one from a statistical and technical perspective. So the second question that I had to you on this front, when you refer to high vol, how do you measure it and what's the criteria you use to say now is high vol versus other times when it's low vol?
I'm glad you asked that question because we're going to show you. Do you mind if I go to my screen for a sec?
No, please do.
Let's see. Can you see my screen?
Not yet.
Now?
Mm-mm.
Hold on one second. Let's do this. Okay, now you can.
Yep, there we go.
Okay, so what? And Tony, I forgot to mention this earlier, but you know, on the webinar today, Kevin and Andy and Brittany are all on. So if you want to ask any questions, they're on the Kevin and Andy are on the trade desk at Tastyworks. So if anybody has any questions, just so I'm not looking at the chat. So if you're asking me something and you want to ask those guys, just go ahead. They're really clear of the concept. And if you have any tasty trade questions, you can ask Britt. But you know, just reach out to them. We do it to keep the pace moving. So let's say you picked a stock, because this was my biggest issue over the years. How do you know when volatility is high? You know, I mean, you trade 200 different underlyings. How do you know when volatility is high? Like let's say I picked a stock, just crazy, but let's say I picked NVIDIA. How do I know if 59% implied volatility, let's go to October, 58% implied volatility in October is high? Well, we have addressed that on Tastyworks. We've actually started this years ago, which is we have a number called IV rank, which ranks the implied volatility for the last 52 weeks on a scale from 0 to 100. And so the current level is 40 in NVIDIA. This means, you know, on a scale of 1 to 100, it's at 40 right now. That is what we consider extremely high. Anything over 30 is considered high. If I went to the spiders right now, I mean, I wouldn't know if looking at October, if 26 volatility is really high. I mean, you know, because even though we know the means are about 18 or 19, I wouldn't know that 26 is that high, but I can look over here and see it's in the 57th. It's ranked 57th out of 100. That's extremely high right now. And so one of the cool things on Tasty is that we have watch list functionality built in here, which will show IVR from high to low. So you could just go here and you can see, hey, what has really high IVR? Like right now, if I wanted to, I could say, well, the highest on the board for me is the Japanese yen, the 10-year notes, Freeport, Nike, the NASDAQ, Adobe, you know, Micron, and the list goes down, SMH. I mean, there's a million of them with incredibly high volatility. And these are just underlyings that I have positions in. Like you can go to the indexes and, you know, pick something like, let's just say high option symbols. I mean, liquid option symbols, and start looking, you know, what's near 100, you know, here you go. And there's a ton of stocks up here near the 100 range. So I think that since we started ranking implied volatility, it's super simple now. You don't have to guess anymore. You just pick an underlying that you want to trade. And let's just say you wanted to trade Apple. Now everything's going to be high after today, but Apple's 43%. Okay, that's great. So 43%, now you have context around the 35% implied volatility in Apple. And you also here have expected move. So you know that by October expiration, there's an $11 expected move, a 35% implied volatility, and an IVR of 43, which means go at it. If you like trading it, it's got high vol.
So just to answer that question. How do you determine high vol? You're saying when IV rank is above 30, generally
Yes.
speaking, you consider that a high volatility environment.
Yes, and most platforms now, I mean, we started the trend 20 years ago of using IVR, but most platforms, like if you're on, well, I don't know every platform, but if you're on Thinkorswim, they have IVR. If you're on Interactive Brokers, they have IVR. So it's on most platforms. I don't know all the other platforms out there, but you know, I think most platforms offer it now.
Yeah, I would say certainly most platforms offer either IVR or IV percentile. Similar, but slightly different
Yeah, we've done a bunch of studies on that. We offer IV percentile, but we don't use it because it's not as effective as IVR.
It's just easier, I think, to remember the levels of IVR than IV percentile.
Totally.
So this next question, I think we actually just answered it, but how do you determine when it's time to sell volatility or buy volatility? I think we answered the first part of that question, meaning when do you tend to sell volatility? And from what you're saying is that it's when IV rank is above 30. But when do you look at buying volatility? I know that's something that you do fairly rarely.
Yeah, I mean, unfortunately, the answer is never. I mean, you know, that I guess that's probably not fair. I buy a lot of stocks, you know, like, so like if I'm super bullish on something, like I have no problem, you know, buying an underlying equity. I have no problem buying an underlying future. I rarely buy option premium. I will buy at the money call spreads, like, and put spreads. So I will buy debit spreads. I generally don't buy I generally don't buy options. But, you know, if so I guess my answer is I generally, and when I say generally, you know, out of 10,000 trades, maybe 2 I'm buying options. So I don't count that as a, you know, long option position. I will buy debit spreads, and I never buy volatility by design. I mean, there's an occasional time if you're talking about getting long, like if you're talking about getting long like the VIX or VXX or something like that, I mean, maybe I'll sell a put spread in there, but it's really rare for me to get long volatility.
And even when you do buy debit spreads, you tend to buy debit spreads that have virtually no time decay.
I like it even positive. You're exactly right.
Right. So I do think that that's a little different than most people who are buying volatility, who are buying, you know, an at the money, out of the money call or call spread, something like that, to play for a directional move. So I would say that that's a little different. This is actually a good segue to the next question. What strategy would you choose to purchase a stock that has declined significantly to a level that you are inclined to be a buyer? I think that kind of speaks to the market environment that we're in right now. It sounds like you are dipping your toes in some of these stocks. Do you use options to help you purchase these stocks?
Yes, I am a big fan of the naked short put, of course. There's a bunch of reasons for that. One is because I like the high probability of success of selling naked puts to get long stock. B, usually when I buy stock, it's something that's beaten up, which means it has high volatility and low basis, low price and high volatility. So, and I like the high probability of puts. I will do covered calls too. So I will buy mostly with cheaper stocks, but I will buy stocks and sell calls. I have no problem doing that. And I will occasionally do covered calls. I will mostly do naked short puts. And I don't know if you guys ever talk about like a zebra trade, but I will occasionally do that, which is essentially, you know, let's call it buying 2 at the money calls and selling 1 out of the money call. It's just kind of a synthetic long. It's a synthetic covered call.
Sure. You know, and this is a strategy that we talk about a lot, you know, short, whether you're talking about a naked or cash secured. I tend to find that a lot of investors tend to sell cash secured rather than naked, but the underlying option strategy is the same here with respect to attempting to own the stock. Can we talk a little bit about what expiration date and strike price you typically lean on for a short put?
It depends on the the price of the underlying. For expensive underlyings, you know, things that maybe, let's say, a couple $100 or something, I tend to be around, you know, expiration is always 45 days for us. So that's the no-brainer part. But the naked short puts, we've done a lot of studies on this. We found optimal, if I had to give a number, would be 22 deltas. I like to be somewhere between 16 and 20 on a relatively expensive stock. So I'm usually between 16 and 20. If I'm very, very bullish or I'm a little more aggressive, I might go to 25 or 30, but most of the time I'm pretty consistent. On expensive stock, I'll be around 16. On a little bit less expensive stock, I'll be around 20, 22.
Right. Okay. So we have a slightly different philosophy, but again, I think the more important part is having a consistent method, if you will, to things, rather than the exact same. We tend to go a little shorter in time on cash secured puts, just to increase the probability of actually owning that stock. Because a lot of times in a 45-day option, it just ends up expiring worthless and you don't actually own the stock, or a vast majority of the time that doesn't happen. So I think for a lot of investors that are using cash secured puts, we prefer to use a slightly higher delta and a slightly lower time frame to try to increase your odds of owning that stock.
Okay, that's fine. I mean, listen, that as long as you're consistent, that's all I care about.
So here's a question that we started touching about liquidity. And you showed the ranking system that you have on Tastyworks to give users a sense for the liquidity of an underlying option. So do you see any significant changes to options liquidity during a market of higher volatility?
Yeah, you'll generally see greater liquidity. Now, I know that sounds a little weird, but you know, high frequency all the market making firms, obviously, they need to they're very similar to philosophy wise to what we are, which is taking advantage of, you know, taking advantage of the opportunities the market gives you. And the market gives you more opportunity in high volatile markets. And because of that, they tend to be on a relative basis more aggressive. Like if you traded actively today, you would have found that you would have got filled on virtually everything you tried to do, because the markets tend to be much more aggressive. Market makers tend to be much more aggressive in volatile markets. They don't back away like they used to. Now the electronic markets actually get tighter. So I find the fill quality to be much better in volatile markets because of the underlying activity. Like, you know, I mean, look at SPY just as an example. It traded 123 million shares today. You're going to get much better fills on a 123 million share day than you're going to get on a slow day when it trades, you know, 35 or 40 million shares. I mean, if we look at the S&Ps here, the S&Ps today traded 3.1 million contracts. Okay, you're going to get way better fills on 3.1 million contracts trading than you're going to get on, you know, on a small number. And if you go to certain underlyings, you know, like just like looking, like I'll look at Tesla just as an example. Like Tesla today, I mean, it's only down $12, which on a relative basis is not that much. But when you think about Tesla, it traded 60 million shares, you know, or almost 70 million shares. On a normal day, it trades 25 million. So the fills in here were 2 cents around theoretical. You know, so you're going to end up with the ability to get fills on days that markets are busy and highly volatile that are much better than slow days.
Yeah, we've actually done some of this research here as well in terms of effective spreads. Effective spreads is referring to the distance between the midpoint and the price at which an order gets filled. And we actually saw an improvement of effective spreads on highly volatile days. I think we were comparing a day when the VIX was well over 35 versus a day when the VIX was around 15 or so, that the effective spread, the distance between the midpoint and the fill price of a strategy was tighter on those more volatile days than on the less volatile days. So I think that kind of aligns exactly with what you're saying. But I think from and this is a good segue to a question that we do get a lot of questions on with regards to liquidity. You know, we get a lot of questions from customers saying, and we can bring up even probably a Tesla options chain. More so, I would say you see this more so on the weeklies than you do on the monthlies, where you occasionally find strike prices where there's very little open interest. on a specific strike. So look at that 296 and 67, as you can see. Oh, that's volume, right? So perhaps
Well,
less so on Tesla.
This column's open interest. This column's volume.
Right. So less so on the monthlies are you going to see strike prices with zero volume. Sometimes on weeklies you'll see even in the first couple of weeks where there are just some strike prices that have very little volume or open interest. So I tend to see a lot of questions from customers saying, why would I trade a 320 strike on this when it has 4 contracts of volume today and 3 contracts of open interest? Could you speak a little about that in terms of how that has virtually nothing to do with liquidity in terms of how much open interest is available at a specific strike?
Yeah, now it depends on the underlying, but if the underlying is trading 60 million shares, open interest is irrelevant, like in Tesla. And the reason that you don't see a lot of open interest in some of the weeklies is because most of the professional action goes to the monthlies. And it's just the nature of the business. But if you want to trade weekly options in Tesla, my recommendation would be, if you spread things off, your fills are going to be much better than if you try to do individual options. Now, Tesla generally trades 2 to 3 cents around mid price on any kind of spread. So whether you're doing a credit spread, a debit spread, an iron condor, naked strangle, whatever it is, everything trades about 2 or 3% around 2 or 3 cents around mid price. If you're doing a naked option, a little bit different, it's going to trade about 10% around 10 cents around mid price. So, or sometimes 5 or 7 cents, just depending on how efficient that market is, or that time frame is right there. But the open interest in a stock like Tesla is pretty irrelevant, totally irrelevant. Volume and open interest are not that important in a stock that's highly liquid. I mean, I think Tesla is the most liquid stock next of any of the individual equities. So in stocks like that, open interest doesn't mean a thing.
Thank you for that clarification. So I think we have time for one last question here, and I think this is a good question to kind of to end the session here. We spent a lot of time talking about the mechanical rules and how important it is to have mechanical rules whenever you're trading. The question here is, do any of those rules change when things turn more bearish, or more importantly, when things become more volatile?
Here's the crazy thing about this business. It's a great question, because nothing ever changes. The strategies, I know you're going to think this is insane. The strategies that we do today are the same because everything is symmetrical. Risk is symmetrical. The risk across the board. The risk is symmetrical. The models get tweaked, and the markets are better, and access is better, and everything's faster, and everything's more tradable because there's much more liquidity than there ever was before, and there's more efficiency. But the strategies don't change. The optimal mechanics don't change. The approaches don't change. We just know more today. Like the stuff that, Tony, the stuff that you're teaching today, and the stuff that you're reviewing and going over so meticulously, this is the stuff that never existed before. It's not like anything has changed. Like we were doing butterflies and broken wing butterflies and verticals and iron condors and short strangles and ratio spreads 40 years ago, 30 years ago, 20 years ago. What's changed now is that we just trade everything. And instead of size being the king, it's really a much more strategic approach. Like we are really gearing ourselves towards the longevity in this space and being able to just, grind it out for a long period of time. And that's what's changed, is product indifference, optimal mechanics. I never knew any of this stuff before. Like I traded for 20 years before I knew like 10% of what I know today about, just like the mechanics of what we're doing.
Well, I really appreciate the time that you spent with us here today, sharing with us all of your knowledge. I think this is incredibly helpful for a lot of investors who are finding these days like today tough to navigate, sometimes a little bit scary in terms of understanding how to adjust your portfolios and how to lean into this volatility, if you will, but hopefully this gives you some insights into how you can go about leaning into this volatility and potentially harvesting this volatility for opportunities. But I think the most important thing that I want to take away from this is really, as you were talking about, Tom, at the beginning, is longevity. Being able to survive through these types of volatile times is more important than anything else. And the way to do that is by controlling your size. You said there's a few things in our control. You can control your size. You can control, and sizing, I would argue, is probably the most important thing to control as a trader, so that you don't, in any single day or any bad week, blow up your account because you traded too much size on one specific idea or one specific thesis that didn't potentially play out for you. So with that, I just want to do a little bit of housekeeping before we answer. We'll try to answer a few questions here with Tom if he has a minute from the audience that you guys have sent to us. But before we do, I just want to remember, for those of you that are interested in setting up a Tastyworks account and trying out the platform that Tom just showed you, you can do so using the link here on your screen, which I will post into the chat window. For opening up a Tastyworks account and getting access to IVR, getting access to liquidity screeners. Both of those do exist here in OptionsPlay as well. So you can use the combination of OptionsPlay and Tastyworks to execute the trades that we discuss and learn here at OptionsPlay. And for those of you that are brand new to OptionsPlay, you can sign up for a free 30-day trial at optionsplay.com. You'll get access to our platform, education like that Jess and I host every single week, including with guests like Tom, and help you understand the timing of the markets with our chief market strategist, Rick Benson-Yor. So Tom, with that, I think there's a couple of questions here in the Q&A that I would like to see if we can try to answer before we jump off here for today.
Let's do it.
Let's see. So let's talk a little bit about when you were referring to, I'm trying to find that question here again. Oh, please explain adjusting deltas. I'm just starting out with my first strangle. Could we go through an example of this? Perhaps pull up the platform and explain what you mean by adjusting deltas on a strangle, perhaps that's moving in one direction or another, like we are seeing today.
Yeah, let's do it. Hold on. Let's see. Screen share. Monkey. Okay. Do you see my platform?
Yep.
Let me just take a look here and see if we have a small position somewhere, which is just a plain strangle. Okay. So this is, I'm just going to move this over so I can see. This is a Netflix. You can see over here. This is a Netflix strangle, 20 contracts, right? Oh, you know what? This is going to make it too hard for this person because this is inverted. Hold on a second. Let me do something different. Let me type in, I don't want to give you I don't want to start off with an inverted strangle. Here, this is not inverted. So this is IWM. This is 30 strangles, okay? I'm short the 186 call. I'll pull it up on the screen and you can see it. So here's the strangle that I'm actually short. This comes in green now because I put an order in to close it, just as an example. But let's say that this strangle right here, I'm looking at this strangle going, you know what? I need a few more short deltas on the strangle. This is the strangle I currently have on, but I'm short it, and I put this order in here to buy it back. And just to show it to you so you can visualize it on the screen. And it's a tiny short delta strangle. But let's say he said, hey, you know what? I think we're going lower tomorrow. I want to get a little shorter. So I'm going to remove the put side because we never adjust the side that's being challenged. This stock was down $7 today. The puts would obviously be the challenge side. So I'm going to delete this and never touch that side. So now I'm short these calls and I'm going to buy them back, the 186s. And in order to adjust my delta, I'm going to buy these back, but I'm going to sell the 183. So all I'm doing is selling this call spread. I'm selling the 183s. I'm buying back the 186s. When I fill this trade tomorrow morning, if I want to, I will now be short the 183s. Let me delete this. And on the put side, I'm still going to be short. Which ones are they? The 178s. So this will be my new strangle tomorrow. And all I did was buy back this strike and sell out this strike. And then this turns into my new strangle. Now my delta, this will be a shorter position, and I'll show you in a second how this works. Delta. So I was short the 186s, which were a 42 delta. I roll it down to here and I'm short the 50 delta. So I pick up 8 deltas per each contract. So if you look at this here, that's 30 contracts times 8. That's 240 shares of stock. That's an adjustment. You adding 240 short deltas to your position. That's how you adjust your position. Now, let's say tomorrow I get fooled and the market I do this trade, and then later in the day, the market starts to rally. So now my calls are being challenged. So I'm going to delete this side for a second, and I'm going to take these 178 puts, and I'm going to roll them up. I'm going to roll them up by buying back the 178 puts. I'm going to buy the 178 puts back, and I'm going to sell the 181 calls, let's just say. I'm going to pick up on this side now, go the other way delta wise, go from 38 to 45, pick up 7 deltas times, 30 contracts, pick up 210 shares of stock, the theoretical equivalent. And now I've rolled my position back up. So now my new position looks like this, short this and this. Now you're going to say, well, hey, that's not a strangle anymore. That's almost a straddle. So what you do then is, I know you're going to think this is crazy, but I'm going to delete this leg. I'm going to buy these back. I'm going to delete this leg. I'm going to buy these back. And now I'm going to buy this strangle back, and I'm going to go back out and sell the wings again. This is what we call recentering. And this is a very classic move that on days like today, you do all the time. You buy the guts. These are the guts. And you sell the wings. These are the wings. The 2 red ones are the wings. These are the guts. So what I did was I started with a traditional strangle. I rolled the calls down to adjust my delta to make myself more short. I then later on when the market rallied, I rolled my puts back up to adjust my delta to make myself a little bit more long. These strikes got too close together, so I'm buying them back and reestablishing with another by recentering my strikes. And you could never do this until we built platforms like Tasty, where you do all this in a single click and you're done, and you give up 1 penny or 2 pennies around theoretical at the mid price. It's amazing. I do it all day long. I adjust these things. Like here, this is IWM just today in this account, made 1, 2, 3, 4, 5, 6 adjustments today on a 7-point down move. That's a classic, lots of adjusting that keeps you in the game.
Well, thank you so much for that in-depth
that was kind of heavy. That was kind of heavy.
It was heavy, but there's a lot of times we talk about the concept of rolling the untested side of a strangle. And I think for a lot of traders who are new to strangles, that sounds like a lot of jumbo jargon that doesn't really make a lot of sense. So hopefully this gives you a clear sense for what that actually means of rolling the untested side of a strangle. So let's go from the deep end of the pool to the shallow end here. There was a question about cover calls. You were before we were talking about selling cover calls, and I think we can talk about this for both cover calls and cash secured puts, or naked puts rather.
Sure.
You're talking about 45 days as an optimal expiration date. When do you ever let them expire worthless?
Never. Almost, I shouldn't say never, but I would say very close to never.
So let me ask you this. When you're selling a put for a stock that you're looking to acquire, do you simply close out that put at the time and then simply outright buy the stock?
I usually sell the put, buy it back, and then sell another put. Keep the game going.
So you never actually get long the stock.
No,
I just short the put.
I do get long stock. So there are stocks I actually buy outright, and there are stocks that I actually get long because I get assigned, on the put. So occasionally, if my put's in the money and I still like the stock, I will take delivery of the stock and I will sell a call against it. But for the most part, it doesn't happen too often.
Got it. Okay. Thank you for that clarification. Let's do one last one before we wrap up here for today. We've answered so many of these questions already today.
Yeah, it's been great.
I really tried to bring out all the questions, and it looks like we've answered almost all of it. Maybe I'll end on a comment from Harley Bob. He said, "Tell Tom that the next time he joins us in such a down market, he needs to give us each 3 fingers of rye whiskey first."
If I had any rye whiskey, I don't think I've ever had rye whiskey. Not a whiskey drinker, but sure, why not? Whatever you need.
All right. Well, Tom, again, thank you so much for your time this afternoon. This has been fantastic. This has been a great session. This has been a lot of fun. We hope to have you back here in the next couple of months. Looking forward to it again. And for those of you watching here today, thank you for joining us from around the world and sticking it out for the full hour with Tom and I. I really hope this was helpful in giving you a better understanding as to how to navigate the current market conditions that we find ourselves in for today. Thank you so much for your time, Tom, and thank you so much, everyone. Have a great afternoon. I'll see you guys here tomorrow morning.
Thanks, guys. Thanks so much, Tony.